Okay. Originally from Colombia. I'm also originally an optometry doctor. That takes by surprise a lot of fellows that have known me for several years, preparing taxes and doing some bookkeeping and payroll. Also have been here in the US and working for this same business, La Oficina, since 2003. I've been a father since 2009. I'm a business owner since 2011. That is the same business. I worked since 2003. I acquired it, so I became a business owner with all the challenges that come with it. I got my enroll agent credential in 2016. That is a credential the IRS provides to some tax preparers who can demonstrate through testing that we are capable for individual business tax as well as other type of federal taxes. And I'm also a lifetime soccer fan. I prefer to call it football, even when here is the opposite, but we can all agree to disagree. And this is just all to say that things have changed in my life. Things change a lot in everybody's life, and businesses, that's a machine that changes a lot. And we have to be aware of what challenges and what consequences bring every single change. So with that introduction myself, I can always make you smile. That's what I try to do with my clients, even when the tax situation is not the best. There is always a bright side on that. What I mean is that I know that my client is not surprised when the business grows, that brings extra revenue and that brings extra taxes. But I can also always make that part of the bright side of the business, being a business owner when the business grows. It is, that is one of the objectives of entrepreneurship, is trying to make something work also financially. And that is a very positive way. We know that that comes with consequences, and one of those is taxation. So we need to be prepared. We need to know the basics, and we need to be able to manage. And we can manage only if we have some of the basic knowledge, and we can use it as a tool. So these are some fun facts that I found about taxation. So there was a former IRS commissioner that went to prison for tax evasion. He was busted for evading over $90,000 in taxes, and he ended up in prison for about 5 years. Also, Peter the Great tax beard. I didn't know that. Most of this stuff that is in the screen, I didn't know. But those are fun facts that happened in Russia in the 1600s. Also, Willie Nelson, he got into some tax trouble, and in order to pay his tax liabilities, he made an album. Now, the name of the album was called the IRS Tapes. Also, even astronauts in space, they need to file their taxes. There is a story about Jack Swigert. He was one of the pilots for the Apollo 13, in the middle of preparing. In fact, he was one of the latest additions to the cruise. So he realized that while he was in space, that he was going to miss tax due date, which is April 15, and he had to radio command to Houston and just say that he needed help filing an extension. So that was also a fun fact. Now, no so fun is that, there is a tax court, and that there is a lot of time and effort, and especially time that we all spend getting our records straight. An individual usually spends about 11 hours, while business filers spend about 20 hours. Most of that is just in record keeping. So with going in a fast pace, because we have a lot of topic to cover, a lot of ground to cover today, I like to use fancy words like overture and what was the previous one? Prelude. This is because it is just fun as the type of terms that I find in the tax code that amuses me. I don't know what it means, so I have to go deeper. So as an introduction for what we're going to see today, we're going to review principally income taxes. But I want just to remind everybody that if you own a business, you may be subject to different other taxes: sales tax, withholding tax, payroll tax, property taxes, excise taxes, estate taxes, also called debt taxes. There are so many different things. We're just going to concentrate today in what is income taxes. And my objective is that you have all the tools so you can gain control of your own tax situation and you can plan better. You can just pretty much help yourself. So now, I remember going to school. One of the things that I hated from some of my teachers was, as I was just getting ready to get comfortable in my chair, they just popped a quiz, and I hate it. That's what I'm going to do today. This is something very, very simple. I just have 7 questions, and I want every one of you just to keep a tally. So just put a 1 or write somewhere. Just get a paper and pen. And if the answer of the question that I ask is yes, then just put a 1. If it is no, just put a 0. And at the end, we are going to add all the numbers, and we're going to see what the responses mean. So one of the basic questions that I always get from my clients is what is deductible and what is not deductible. So I'm going to reply by just asking kind of the same questions. So do you think that your cell phone bill is deductible? So if you think it's true, just put a 1. If you think it is not, then put a 0. So the second one is, what about your rent, your house rent? Is that deductible? What about number 3? What about your mortgage? Is your mortgage payment deductible? Number 4, is your car payment deductible? Are your meals deductible? Number 6, is your golden chain or your necklace deductible? And the last one, is your pet deductible? Perhaps do you think that you can claim it as a dependent? When a client asks me that question, I say, sure, only if you can bring me a social security card, we'll see what we can do. But for tax deductions, is your pet deductible? So if you can quickly add those numbers, I'm going to tell you what it means. So for those who answered the total numbers at 7 or a higher number, yeah, you're correct. All those can be deductible. Now, for those who have lower scores, like 0, 1, 2, you can also be right. So the thing is that everything can be deductible. Everything can not be deductible in your case. So that depends on circumstances and your personal situation or your business situation. So we're going to review some of the basics on taxation, starting with income. So yes, most of the questions that my clients have is what are tax deductions? Is something deductible or it is not deductible? But I really, really want to start with what is income, because that's a point that is overlooked usually and very, very much misunderstood. So there is a little bit lack of knowledge on what needs to be included as income. So as you can see in the screen, yes, for tax purposes, cash is income. If you receive any kind of payment, whether it's credit card, checks, cash, even virtual currency, Bitcoin, that kind of income that you receive in you for what you provide as products or services, yeah, that is income that has to be included on your tax return. Also, property, that is FMV. You're going to see a lot of abbreviations. I'm going to tell you what it means because it's very commonly used. So fair market value is what FMV means. That means that if you receive something in lieu of services that you provide, for example, if I don't know, you receive a tablet. So the fair market value is what that tablet is, in the market if you buy it in the condition that you got that property. And that has to be reported as income, even if it is not cash. Also services, that is also known as bartering, that practice in which if I need legal services and I hire an attorney and the attorney needs my services as a tax preparator, then we can just trade, but each of our services has a value. I have to report in income the services or the value of the services that I receive, as well as the attorney has to do the same on his tax return. Now I get to deduct the payments that I make to him. So that is income. Also, constructive receipt. So what receipt? Constructive receipt. That is when you have access to payment, but you're not the person necessarily receiving it, but you have an agent you authorized to receive it. So, for example, if I have, I don't know, a manager, or I have an account that I don't necessarily have direct access right now, but it is for me to use it, that also becomes as income. So the figure of the agent is the most valuable here to understand. And also very surprising, cancel debt. That's surprising, not to me because I know that, but surprising for most of my clients that receive a 1099 at the end of the year when somebody has forgiven a debt. It can be a credit card that has been forgiven or service. That happened to me early in my marriage. My wife, she did receive a 1099 for cancellation of debt. And she was surprised, but she remembered later on that an attorney, she's not a bad girl. In fact, that was a family attorney, but she did receive that form because she was making some payments. And one day, the attorney's office called her and just proposed to forgive the balance. So she was very delighted. She was not as delighted when she received that 1099. So that happens. That is income. So don't be surprised. That has to be included in the tax return. And many of these transactions that I have talked about, they are also reported as income to the IRS, but the payers. So be sure to understand that income is very important to keep track of on a business. Also, most businesses are cash basis. That is a term that is important to know, just to understand the timing of the income and when that income has to be reported. So if I do receive a payment, let's say a client on December 31st comes for a service that I have provided, and I receive a check, but I decided not to deposit in my bank until January the 2nd, the following year. So that doesn't mean that I'm going to report it as income in the following year. That is income for the year in which I receive with no conditions. When that means pretty much when I am with the full right to use that and dispose of that money, that's when I'm going to include it in income. Also, that applies for deductions. Is if I write a check to pay for I don't know, rent for my business location, and I decided to write the check on December 31st, but I don't mail it until the 3rd of January of the following year. So I cannot deduct it in the year that I wrote the check. It is when I just surrender and I have no longer control over that payment. That's when I can deduct it. So you see, it's not about like what is deductible and what is not. It's also all these facts, timing and type of income, etc. So let's start now with deductions. Basics about deductions. Business expenses are always deductible. Doesn't matter how you pay for them. You can pay in cash, you can pay in credit card, you can pay with a check, debit card. So this is just to clarify, because many of my clients, they don't think that payments with credit cards are necessarily deductible, or that they are deductible only when the credit card payment or the payment to the credit card company is made. It is as soon as I made the purchase, usually under the rules, I can deduct it because I'm liable already before the credit card company to repay them for that. Also, some business expenses that are paid in advance may be capitalized. That means that if, an example, insurance premium for 3 years, I buy my insurance premium and that is a 3-year policy and I can pay it in advance. And if it is like $3,000 for the following years, I can just deduct the portion that corresponds to this first year. And that is the only portion that I can deduct. The rest is capitalized. Capitalized is pretty much, it is just accrued to be deducted in the year in which that insurance corresponds. So there are a lot of expenses that may be capitalized. And some other expenses is, for example, going to business. A lot of new entrepreneurs think that just because there is a lot of investment in the first year, they can deduct everything and that is going to result in a huge loss. And not necessarily, because going into business is pretty much an investment that is going to bring some revenue in future years. And what the IRS usually wants is to try to match income with expenses. So that's why there are these rules. There are some startup expenses that they can be deducted in the first year. There are some others that not. Usually, if the business does do a lot of investment in the first year, but does not go into business until a later year, so everything is capitalized and it's just going to be deducted when the business is operating. Also, capital improvements, repairs that for example, a restaurant leasing and a commercial space that has to invest a lot in just putting walls and doing a lot of improvements and big repairs. They do not necessarily, they are not necessarily going to be deducted in the year in which they are spent. They have to be capitalized in most cases. That means that we are going to take a deduction in pieces. We're going to distribute that in certain amount of years, depending on the rules. There are rules for 15 years and there are rules for more than 15 years. Also some flippings. That is very common nowadays with the craziness of the real estate market. People who buy, remodel, and invest, and they sell the property. That doesn't mean that everything that I spend in 1 year flipping a house is going to be a deduction. It usually happens is only when I sell the property. So timing is of essence in these kind of transactions, especially flippings. A lot of capital is involved. So usually when that property is sold, that's when everything that has been invested into that property will become taxable. Some business assets purchase may be depreciated. That usually happens with big purchases as equipment, cars, trucks, etc. Those big things that has a value on a lifetime of more than 1 year, they usually are depreciated. The good news is that we have some protection. We have options pretty much with what is called Section 179, that is pretty much depreciating or not depreciating, expensing out in the tax return, deducting the whole amount of some properties. There are some rules on what kind of property qualifies for this tax benefits. There is also something called bonus depreciation. So you can see we have been just over 20 minutes and there is a lot of information packed in here. Not trying to put 70,000 plus pages of the tax code in 1 hour, but I just want to communicate with you with the things that I'm mostly asked by my clients, most commonly asked by my clients, and this is what I see on a daily basis with entrepreneurs and small business owners. So now we have talked about income and deductions, and yeah, I know what you're thinking. This is very interesting. That's a lot, but my real question was, what is deductible? So if you want to list of what is and what is not deductible, good luck, because I don't think we're going to find it anywhere. But as we reviewed at the beginning, pretty much anything can be deductible for as long as it complies or is within the general principle. So this is what TSM says in one of the IRS publications. In order to be deductible, a business expense must be both ordinary and necessary. Ordinary expense is one that is common and accepted in the kind of industry your business is. And a necessary expense is one that is helpful and appropriate for your trade or business. Well, this is a list of the most commonly overlooked deductions. This is what I see from many of my clients. This is what I have read other colleagues see as not taking advantage of. One of those is the home office. So for the home office and every deduction that we have in here, most important thing to understand, there are rules. So not necessarily because I use my home as an office or I use a little piece of, I don't know, my garage as my office, that doesn't mean that I'm going to be able to deduct. So there are some rules. But pretty much if my kind of business needs an office and it is not necessary to rent a commercial space, also because it's much more expensive, but I can operate my business from my home and I have a, let's say a room, a place that I can convert the whole space into an office and it is necessary for my business and I can justify that. So I can claim the home office deduction. It can be portion of all the household expenses, rent if I'm paying rent, or part of the mortgage insurance, also depreciation of that space. That is a depreciation of the home, but just a portion, as long as a portion of utilities and every single expense that a house in its entirety has and for which I have also paid. But important, it has to be a place that I usually do business at. Also car expenses, not necessarily car expenses is a deduction that is overlooked, but the record keeping for car expenses is something that I find very difficult for many of my clients to keep, because that means keeping a log of every single travel that my client makes for his business. So keeping a log is important. The good thing is having cell phones with apps that can track with GPS and just create a record for that. That is most beneficial. So using those tools is very important as well. Expenses paid in cash, petty cash, those small expenses at the end of the year can add an important amount. Business startup and organizational cost. That's what we talked a little bit at the beginning. I have throughout the year several clients coming just for consultation. Hey, I have this idea. I want to open this kind of business, and I want you to guide me on, what should I do in the process of registration and tax planning and all that. So that is an expense. That is organizational cost. That is deductible. The important thing is that you keep those receipts until the business is fully operating. Research and development, also interest for property that you buy and finance, and carryovers. So carryovers is some stuff that has happened in previous years, which cannot be deducted because of, limitations, for example, and then can be deducted in a following year. And if you don't carry over that amount, that is lost, and that is a deduction that can trigger a higher tax bill than the one that is necessary. Now, what is new for the year 2021? When I'm talking 2021, that's the year that we're going to start filing pretty soon. By the way, IRS announced that tax season, that means the official date in which the e-filing center of the IRS starts processing returns, is January the 24th. So it's just a couple more weeks. So what is new for 2021? I have some of the personal changes or individual return or individual tax changes, sorry, as well as some of the business. So on the personal side, FSA, this is flexible spending arrangement. It's related to health. It's not as common as the HSA. Some of you may already have them or have had them in the past. That allows now for employers to amend a plan to create a rollover that was not permissible under previous legislation. So that's a good thing for some. Some of the contributions to charitable organizations. I don't know if you noticed in the tax return in the previous year, there was a new line that allowed some of those deductions. It's just a small portion, that it was just $300 to be deducted, even if you didn't itemize deductions. So just to give a little bit of background, the standard deduction or the itemized deduction is one of the biggest deductions on the personal side of the return that allows you to just wipe out, depending on your filing status, about $12,000 or $24,000 if you're married, and you don't pay taxes on that amount. So standard deduction is standard because the government provides the amount to be used for a certain year. The itemized deduction is the one that I can use in lieu of the standard deduction, and I use it when my itemized deductions are higher, and those nowadays comprehend charitable donations, some medical expenses, taxes paid to the state or localities, and so that's pretty much most of the ones that we have. Remember that we got stripped out from most of the other standard deductions back on 2018. So this is just to say that even when those charitable donations are taken in as an itemized deduction, that whether you itemize and use it or you don't use it at all, the government allows us now to take those $300 now for 2021 for married couple filing a joint return. That increased to $600. That is the new part for 2021. The economic impact payment, that's still one of the tax reliefs or the incentives, economic incentives that we receive just because of coronavirus and all the pandemic. Remember that the government authorized a last round of those payments for $1,400 per individual. The important thing to know is that not everybody received those because those are limited by income. The amounts are on the screen. The new part is that if somebody has not claimed, if someone did not receive those payments when they qualify for those payments, they can claim it in the return. Same thing happened with the 2020 return with the 2020 payments. So that's good news for some people who did not receive those or didn't qualify based on 2020 amounts because the income was higher in that year. That, like, for example, 2021. In 2021, they may qualify. Any income tax credit, this is probably one of the biggest changes on the personal side for 2021. And the important thing is that the age was changed. So maximum age was eliminated. Usually it's 65 years old. People older than that do not qualify for any income tax credit. That was eliminated for 2021. And the minimum age. So someone who under the previous law was under 25 years old did not qualify for this income tax credit. But now that age got reduced to 19 years old. And that's because a lot of young people had to go out to work to also help paying for household expenses. Now that age is 24 for students who pretty much are more than half-time students. Investment income, no one qualified before if the investment income that they had, passive income, was $3,500 or more. So that limit increased to $10,000. So that's a very good thing to see for this year. And the credit amount and income limits increase for those who have no children. So I mentioned that credit because that is very common, and that is one that I'm mostly asked when somebody comes to prepare the tax return. Dependent care credit, this is a big change in what regards the amount that is allowed to be considered for that credit. So dependent care credit is when you send your child, and they're 13 years old, to be taken care of while you work, and you spend, usually childcare is not cheap. You spend a good amount of money. The government has a provision in which you can deduct a percentage of the first $3,000. So under the new legislation, that it was increased to $8,000. So we pretty much I'm gonna see this credit more than double for some folks. And the credit also was increased based on the income that the person made. Now let's go with the business-related updates. The PPP. So remember, the PPP is something that has evolved. Even when we no longer have PPP, still in December, there were some changes in the legislation. So I want you to be aware of those. Many businesses apply for what is called the Payroll Protection Program. Those are businesses usually with employees. And the government helped paying for those payroll expenses with some extra payments that the government gave as a loan. Most of those loans were forgiven if they were used to pay for those payroll expenses through 2021. Now, remember that as soon as that legislation came, the regulations about if that that was taxable income or it was not taxable income. So at the beginning it was taxable, then a legislation came and said, no, it's not going to be taxed. Now the states, they have to decide whether that's going to be taxable or not. So North Carolina at least is not taxable, but you had to make an adjustment in your tax return and pay taxes on some of that amount, especially the expenses that were used for the forgiveness of that PPP money. The latest change is that North Carolina in December made a retroactive change. So that means that many of the people who have already filed tax returns in which they adjusted the expenses to decrease those expenses, they had to pay an extra money in their taxes. Now they can amend the return and claim that money back. So those expenses are now fully deductible. If that was your situation, it's worth reviewing your 2020 tax return and discuss with your tax preparer the options to amend and claim that money back. Just want to be mindful of the time that we have. Now, also new for 2021 on the business side is the employee retention credit. It's not new. This came as soon as the pandemic appeared. I think it was March or April 2020 when the government came with many reliefs. PPP was one of those. This employee retention credit. This credit I'm mentioning now because that has always been changed and regulated. So the latest change is that now businesses who have received the PPP can also apply for the employee retention credit. That was announced, it was last year. And there are some changes that you can still do if you didn't claim those credits and you qualify for that employee retention credit. You can go retroactively and get that credit. That's money also that can help with the relief against the damage of the pandemic. So just not everybody qualifies. There are some qualifications that you have to pass before you can claim those that specific credit. Now, business meals, that is also something that changed. Business meals, that's one of the most common items in my clients' finances, especially those who travel, those who are in the trucking industry, those who have to meet with clients or potential clients in restaurants. They were used to just be able to deduct 50% of those meals, most meals, and now they are 100% deductible only if they are from a restaurant per se. This is among many other changes. So let's talk about how to pay taxes, and this is very important because we, as business owners, we dedicate most of our time is just making sure our businesses thrive, and we do what we have to do, but we forget the consequences, and that are the taxes and how do we pay. So it's very important to understand the three differences or the three different situations in which most business owners are. So before someone becomes a business owner, they have probably been an employee, most likely, and that's a pretty sweet situation in which the employer gets in charge of everything, including making the correct withholdings, sending the payment to the government. So at the end of the year, if everything is paid, and it is usually a little bit overpaid, I receive a refund as an employee. And also the other benefit is that the employer helps paying for the share of FICA. So FICA is what corresponds to Social Security and Medicare, and the employer pays from his or her own pocket 7.65%. Now, when I become self-employed, that's when that FICA is all on my own. I have to pay my own share as an employee and also my own share as my own employer. So it's a little bit more expensive, as well as the issue that if I work out for myself, I'm not making withholdings from my income. So that means that tax accrues. I'm going to end up owing taxes if I don't do anything throughout the year. Now, we have a mixed situation if there is an employee of his or her own corporation. So corporations require that owners who also work for that corporation receive compensation in wages. That's something that we're gonna review a little bit later in one of the examples when I compare non-corporated business with incorporated businesses. So when I am an employee of my own company through a corporation, so some of my taxes are withheld from my wages, my paycheck, and my employer also pays that half share of the FICA taxes. But the employer, being my own company, that means that at the end the money comes from my own pocket. Just to say that, but the advantage is that I have some taxes already prepaid, but not all of them. So I have to account for those that are not paid. Well, how do we pay taxes if we don't have an employer taking taxes from our paychecks? So there is something called estimated taxes. Those are paid on a quarterly basis. That are, if you see, the dates are not exactly like exact calendar quarters, but there are 4 payments throughout the year: April 15, January 15, September, and in January of the following year. Of the 15 of each of those months is usually when the payments are due. So estimated payments means that I'm going to pay taxes on what I think my income is going to be. So I have to have some numbers ready for when those dates come, so I don't overpay, and most important, I don't underpay, because if I do not pay or underpay, I can be assessed some penalties, and that's going to make my tax more expensive. Also, there is a rule that if how much do I have to pay to avoid those penalties? So the idea is that I pay all my taxes, right? I don't want to overpay. I don't want to underpay. But the penalty applies when you underpaid if you don't pay what it was, 100% of the total tax that is on your return for the previous year. You are also allowed to pay 90% on the total tax that is gonna appear on your tax return for that year. So the difficult part here is we're betting on the future, and that is something that is difficult to do, because business is an animal that changes every single day. There are good days, there are bad days, and regulations and weather, pandemics, that kind of stuff just changes whole perspective on a business. And we try to do our best with what we have and try to get some calculations together just to make sure that we pay. That also applies not only for federal purposes, but as the states require those estimated payments. So now let's go with tax planning for business owners. So this is the part that I actually like the most, because I can play with the future. I cannot play with what has already happened. I can just go back and try to retrieve all the documentation that I need to make sure I don't miss anything, but I cannot change the facts of the past. But I can make sure that I utilize all the tax tools that I have to make sure that I either save in taxes or have a strategy to defer taxes if I think that's going to be financially in my favor. So the most commonly used tools and most important tools is retirement. Self-employed individuals, business owners, can make very, very good financial decisions and tax savings with retirement accounts. IRAs, simple IRAs, SEP IRAs. So there are different options. Just to make a parenthesis, when I explain taxes to my clients, and I say like, okay, what you're going to learn is not easy. It is complicated because the good thing about having a tax code that is complicated is that provides options. And when you have options, you have the right to choose. So you can choose, but you have to know what is available to make the right decision. So I like complexity because that's what I can also help my clients use into their advantage. Okay, so retirement is one of those. HSA accounts. HSA stands for Health Savings Account. Those are just money that you can set aside. So an expense that usually is not deductible, even when, if somebody asks me, are health expenses or medical expenses deductible, I say yes, but you do not necessarily qualify for that, probably because of the income, because the amount that you spend is not that much, because you're not itemizing deduction. So there are many requirements that you have to fulfill in order to have the first amount deductible. Now, with the HSA account, as soon as I contribute, even if I don't have that medical expense, I can also deduct that amount. I can have these kind of accounts in my own business, or if I work for an employer and the employer offers that, I can do it as well. And I can do it on my own. If my employer does not offer that, I can go to a financial institution, provided that I have a health health insurance that provides that HSA account. They have to be compatible, to say. Medical insurance, it's also tax saving. Qualifying exchanges, qualifying exchange. So that is a tool. It's a very specialized tool that some people can use to defer taxes. So when I cannot when I cannot save taxes, I try to defer if it is to my convenience. So I try to defer taxes to a later day in which I may pay less taxes. And that also allows me to have a better cash flow, right? Because I don't have to pay the tax right now, I can pay it in the future. So qualifying exchanges, it's commonly known when somebody has, for example, a rental property and wants to sell that property and want to buy another one. So there is a process called the qualifying exchange. It is extremely complex, but if you hire the right person to help you with that, qualifying person, then you can use that to your advantage. So that requires some planning as well. And for planning, you need to ask early on. There are many other tax advantages that you can use to plan for the future. So record keeping, I'm just going to go very, very quick through this. This material, if you can do a screenshot, that pretty much will be a good idea. But pretty much I say to my clients, save everything you can that has a number in it. For business organization, from tax returns, the receipts, bank accounts, credit card statements, invoices, bills, anything that has a name, a date, and a number that you paid, or for income that you received, just keep it. The time, the amount of time that you have to keep those records with you is usually 3 years after you have filed the tax return. That applies because there is a statute of limitation which IRS can go for those records 3 years after you file your return, but it does not apply if you have not filed a return. Then there is no limitation on that time. Payroll records is 4 years. There are some records that you have to keep more than those 3 or 4 years. That usually is things that you keep. For example, if you build a building for your business, then you're not going to throw those receipts 3 years after you build. You have to dispose of those receipts usually 3 or 4 years after you have disposed or sold or just disposed of that property. Also, IRA contributions. IRA stands for Individual Retirement Arrangement or Account. Those contributions and distributions, they have to be kept indefinitely. Now, to plan for 2022 and beyond, it's very hard to plan for taxes, and that's something that I have learned throughout the many years that I have been in practice. Because what I can say today can be changed by Congress tomorrow, but we plan with what we have right now. But I don't bet everything that I have on it because it might change. And as an example, in 2025, most of the 2018 tax code provisions they're gonna roll back to what we had in 27. That BTS before Trump, by the way. Now, review your tax elections, structure, growth plan, and exit plan. That's probably one of the most important things that we have always to remind ourselves as business owners is to review. Just because we have been fine for 5 years or 10 years, that doesn't mean that there is something better. It's just a review. Tax elections is one of those. That's the next topic we're going to cover. And pretty much last topic, the business structure. If you're an LLC, a sole proprietor, a corporation, a partnership, like what needs to change to make your company more tax efficient, you can use those tools. The growth plan, that is growth, sorry, I'm missing a TH. The growth plan and the exit plan. Those are things that we may have in our heads, but we don't put on writing, and it's a little bit more difficult to put it into motion if we don't have it like fully established and in paper. Exit plan is very important. That every now and then I remind my clients, like, you're not going to be forever, and you need to consider what's going to happen in the future, whether you sell, whether you just pass it on to the next generation, your kids. Something important to have in a plan, and also some contingencies into that plan. Well, so this is the complex part, I call. I bring this topic, and it is like out of the blue. It doesn't necessarily match with the flow that we have had in this seminar, but is very important because this is what a lot of my clients ask, or they just completely miss or misunderstand. it's very common that I have clients come in and saying, "Hey, why do my neighbor has a business and don't pay taxes, or they pay less taxes?" So the thing is that it is not because it's your neighbor. It's not because there is a special treatment. No, it's because there are options, and one of the most important options when one is starting a business, or the business is growing, or the business is changing, is to understand what is the tax consequence of the type of entity the business is founded on. So when I say this is a graphic I made in my hand because I'm pretty bad doing graphics on a computer, but in the left side I have what is called non-corporations, and on the right side we have corporations. So just to give a little bit of background on what an incorporated business is, those are sole proprietors, so an individual running the name without being established with the Secretary of State. Also, partnerships are non-corporate businesses, or LLCs that have been established with the Secretary of State, but they do not behave as corporations, or they have not taken that election to be a corporation. That is pretty much a non-corporate business. Corporations are only the ones, for tax purposes, only the ones that are incorporated with articles of incorporation in a U.S. state, as well as businesses, for example, LLCs, that have elected to be treated as corporations. The portion that I'm not going to cover at all is the legal differences, because for that, there are attorneys that can provide you with much better understanding for that. So, well, now in the non-corporation, so this graphic, what I'm trying to do with this graphic is to just show you that there is a difference in tax even when a business owner receives exactly the same amount of income. So let's say that a business have certain amount of income. It has all the business expenses that can be legally deducted from the tax return, and we ended up with a profit. So this profit, oops, let me go back. I'm just gonna do. Okay, this profit is taxed in different ways. For non-corporate business, employment taxes, federal taxes, and state taxes are calculated on that amount. And I'm just trying to have a, let me see if I can just draw. Okay, I'm just gonna use this. So this profit for non-corporate businesses, they have to pay employment taxes. That is about 15%. There is a calculation that has to go beforehand. So it is more than 15, but with the calculation it's less than 15, pretty much 15%. Federal taxes, that is different depending on the personal situation of the individual, but that starts from 10%, usually it's around 15 to 18%. And there are some individuals that can go as high as 37 in the marginal, the top tax bracket. And we have the state taxes at about 5% is what we are right now in North Carolina. Now, for a business that has been established or that has elected to be treated as a corporation, and just to make a note, there are two types of corporations, S corporation or C. For the sake of this example, is pretty much the same. So business has an amount of income, deducts the same amount of expenses. So this remaining amount is what the owner can take, right? But for a corporation, I mentioned at some point in the presentation that for a business owner who has a corporation, he or she has to be paid with salaries. So that salary is a business expense as it is any other wages paid to any other employee. So that is deducted on the business. So the profit at this point is lesser. And the point that I want to highlight in here is that salaries and this profit pay different kind of taxes. So salaries, for as long as they are reasonable compensation. So reasonable is you pay what you are supposed to be paid for the services that you provide to your corporation. They have to be reasonable. So those salaries are going to pay the same three taxes, right? Employment, federal, and state taxes, these three. But the profit in this case is not subject to employment, because this is pretty much the profit is what the business made, is not what the individual made. So the individual doesn't have to pay that part of FICA or unemployment taxes. So this is a tax saving. This is the main difference between non-corporate and corporation regarding business owners and their taxes. So I have one example. In this example, we have a profit of $120,000. So let me see if I can. I'm trying to delete this amount, but anyway, example. And this example is after the expenses of the business have been deducted, there is a remaining amount of $100,000. The non-corporate business, as I said, had to pay on the whole amount the $17,000 in employment taxes, federal taxes of $13,000, North Carolina about $5,000. So it is approximately $35,000 that a single individual with no children. I ran that example in my computer as well. The net tax can be about $35,000. So as an S corporation, in this case, I have elected the S corporation is the most common one for small businesses and small corporations. We split it $120,000 in $60,000 in wages. So that is part of what the business owner is receiving throughout the year, which is deducted. Plus the other $60,000 is the profit the business owner can receive or can just live in the company. Anyway, the taxes are going to be the same. Employment taxes is $9,000, federal taxes $17,000, North Carolina $5,000. So at the end is $31,000. So what I want to mention here is for the employment taxes on the corporate side, that $9,000, that's a big decrease, right? So we're talking $8,000 difference. The only situation that we have for few more years is this federal tax. Yes, so I reduced my employment tax, but look what happened to the federal. The federal increased from 13 to 17. So my tax saving is no longer the $8,000, is just half of that amount. And that is because something that you see at the bottom, QBID, that is something that Trump administration created. It's a deduction, as a qualifying business income deduction that some businesses can take, usually the ones who have payroll and not an unspecified business. So there is a lot of regulations that you have to just get a little bit deeper on. But that changed the landscape of taxation for businesses. And it is very good tax savings, but that is going to go away in 2025 unless Congress decides to extend or something happens from now until there. So when that happens, we no longer have that deduction. In my calculations, it was $19,000 calculation minimum on non-taxable income, or it's a deduction. So when that goes away, business owner has to pay taxes on that as well when there is a non-corporation. So that to say that difference is going to increase in 2025 if everything continues as it is expected. So this is a just very simple example on those two matters, being incorporated, being non-incorporated. You can run your own scenario as your tax practitioner, your tax professional, to help you run some of these numbers. I do this, especially with clients for whom I have seen there is a big change between one year and the next one. and I see that there is a tremendous growth. So we start reviewing all the elections and decisions that we have taken. Okay, last tips. We are just on time to finish the presentation. Last tips is make sure you consult, you pay someone to provide you with the information to review your tax situation. Consulting is crucial. Don't just call your preparator and ask a quick question, because a quick question is going to have a quick answer and it's not going to cover everything that you probably need to know. Also, ask early. I love those clients who come before they open the business and when they have the idea, so they can put a plan with numbers into motion. And remember that your neighbor's tax savings or strategies are not the same, or do not have the same effects on you. That's a very, very common thing. It's like, oh, but that person paid $10,000 less in taxes and he made more than I do. Might be right, might be wrong. I don't know, because I don't know that other person's tax situation. I don't know what they're doing. Anyway, what I work is with my client with all the tools that we have and the personal situation my client has. So that is the end of the presentation. I know that there is a lot of information, but again, taxes are not simple, but we can use it to our advantage. So happy tax season. Hope that everybody has a pretty good understanding and start taking some actions for the future.
We will try to be happy. We'll do our best. So I got a bunch of questions. Whoever wants to stay around, Guillermo said he'll answer these. We don't want to go into too late, but because we did just set this up for an hour, but I'm gonna throw these at him, and if you have any others and we can fit them in, we will try to do that. I'm gonna work backwards because some of them apply to what we just talked about, and I think it'll be good to work through those real quick. So there's one. It says, "Is it true that it's only worth having an S corporation if you make more than 50,000?"
No. In fact, the scenario that we just ran, we're talking about $120,000. So the more money you make, probably the better savings that you can have. But again, that is just an example of many different options that we can use. And it's just one of a very particular situation among many other situations. So we're talking about an S corporation versus a C corporation, or are we talking about a sole proprietor or a single member LLC versus an S corporation? And it also has to do with the reasonable compensation for the activity that person is making. So not all trades are paid the same. So reasonable, it depends on the personal situation. But I not necessarily agree that it works just for below $50,000. It's pretty much the opposite.
Well, yeah, I think she meant upwards of 50,000. It's kind of like I've heard the number as well, but.
Yes, and I'm just going to go very quickly to these numbers. So remember that in the example that I gave, the less money the person makes is going to leave me less room for profits, and I get the tax savings on those profits because it's passive income. I cannot change my wages, right? Mm-hmm. If my reasonable compensation is $50,000 a year, and all the profit was spent on paying my salaries, so at the end I have zero profits. I have no gain at all. In fact, it can happen the opposite, that when I pay more, my salaries plus unemployment taxes and everything, I can end up with a loss, and I have already paid self-employment taxes or FICA taxes on the whole $50,000, and I'm still having a loss. So it can go the other way. So I agree then with that $50,000. It's not a magic number, but talk
about it with your tax professional.
Mm-hmm. Yep.
Make sure you look at. All right. We have another one. It says, do you have a recommendation for how to find a good year-end tax accountant? What is the secret?
So
Should they have
Mhm.
should you look for somebody with numbers or letters after their name is kind of maybe one of.
Okay, yeah, the credentials. That's what I was gonna say. Yeah, credentials make a difference. If somebody has no credential, there is no requirement for continuing education. So that means that if I don't have a credential, I can still be living in the early 2000 tax law, and I'm going to miss on many of the things. And also, to be credentialed, we have to be tested. To have a credential, we also have to be registered. So have in mind that not every tax preparer is registered with the IRS, and many of those, some of those might not even be fit to prepare a tax return. They might not sign a return because they don't have a registration. So it's a tricky thing to go with somebody who has no credentials. So it is better, of course.
Okay. There's another one. It says, they're asking about deducting a car payment or a car purchased specifically for the business and only used for the business. What can you deduct in that case?
That's a very good question. So if it is a business purchase, we mentioned at the beginning, is deductible. So make sure that if you have an entity, the car is purchased and put under the name of the entity. So the entity can deduct the value of the car, not only the use, which is gas, plates, insurance, oil change, and all other expenses that come with just running the car, but also the car itself. That is a very big investment. And you want to make sure that you can deduct it. So if you have an entity, just put under the entity. And you also have to keep that log that I mentioned at the beginning. If you don't have a log and you go under a tax audit, it's likely that they're not going to allow the deductions for running for those daily expenses for the vehicle. And you can also miss on the deduction of the vehicle itself, either through depreciation or, but yeah, it's important. And that is a very important expense. In fact, I have so many clients providing services, and that, for example, construction, they have to go from one place to another one. So having a car is necessary for them, and they are allowed to take that as a deduction.
Another interesting one was, it says, can I deduct all the starting investment, I guess the startup investment for my business, that I made before I got an EIN number? So I guess sole proprietorship for a while, got an LLC or got an EIN number. Is there a cutoff there, and then you kind of start fresh? Or
No, the EIN number, in fact, is not a mandatory number. There are many businesses they don't need. IRS has a very good document on the understanding my EIN, and many businesses don't require it, because if they don't have employees, they don't not subject to payroll taxes, and there is no other reason why the business will need it. It's not necessary to have a EIN, and that is still a legitimate business. Now, it is worth it to consider having just considering whether having an LLC just for protection is better or for tax evasion is better. And in those situations, you might need an EIN. But those are two different situations, two different animals. And you can deduct those original startup business expenses regardless of EIN. The important thing is that you actually start the business, so you have income to deduct it against. If there is no business at the end, I don't think you can deduct it. And also make sure that it is a business; it is not just a hobby. So there are some rules on that, but yep, it is deductible regardless of EIN.
Here's another one about deductions. Do we have to document all of the services we receive through business coaching services or scholarships, etc.? If we do this, do we need to contact the people who provided the services to learn what their rates would have been? I guess if they provided services for free and we want to deduct them.
Yeah, so that probably, if I'm not mistaken, has to do with bartering, exchange of services. So yeah, I'll suggest just going back to the source, whoever provided that service for you. And if you have not that option, then just do a little bit of research, part of Google, local businesses providing the same, so you can have an idea on what the fair market value of those services are.
Okay. I think I covered all the ones that were in the chat. Here's one other one that just came in. It says, piggyback to the question that we just talked about. What if I started two different businesses as a sole proprietor? It says sole proprietor LLC. Can I deduct startup costs for both? Is there a certain way I have to show this? Or can I jump together since it's all a pass-through entity?
So and just to clarify on that question, so there are two different LLCs. So yeah.
If you want, Nikia, can you come off mute and just explain it to us?
Yeah,
she says better. Example.
Hi. Yeah.
Nikia.
Hi, good evening, and thank you guys for having this. I have ventured into doing Turo as a side business. I only have one LLC though, and I was looking to do Airbnb. I haven't done it. And so naturally I'll probably establish another LLC, but I was curious to whether if someone already had those two side businesses going and it's just themselves under an LLC, can they deduct the startup costs for both businesses or both business ventures, or and if they can, do they just lump them all together, or is there a special way you have to file it, like itemized or something?
There is a very, very specific situation. We'll have to see all other the rest of the background on how those LLCs were established, if they have an election as a corporation or not. Many LLCs end up in the tax return for the individual, maybe under just one Schedule C. But it has to do a lot with how the business was established. So in that situation, there might be the option to just get all those expenses together and be able to either deduct it or capitalize it, as I mentioned in presentation. But it might not if the trades are completely different. So it depends. There is something also called, what you do is a business research for expanding your business. So if that qualifies for that, that will be a deduction, maybe a capital expense as well. So, but I would suggest in your particular case is just to have a personal consultation and see the other facts around your situation.
Okay, thank you.
You're welcome.
Just because there's a comment here on the EIN, and I agree, it's something that we've seen. We usually say, get an LLC, go ahead and get an EIN. The bank usually asks for an EIN when opening an account. So what is the, I mean, could you say, might as well get an EIN, or is there some reason you would want to try to stay away from it? It also kind of protects your social security number, I guess, in a way.
Yes, all those. Check, and check. Yeah, I do agree. The EIN is a pretty good tool to try to keep part of the business as incognito as possible, especially with everything that is happening with your personal information and how all the safeguards that you have to put. That will be one more. And I have seen lately all the banks asking for that, probably because there is a lot of fraud with businesses that are really not businesses, but they're just taking advantage of that figure of having an LLC and that a formality. But yeah, it's a good idea to have an EIN if you are an LLC. There is a reason why not. I mean, it doesn't cost, it doesn't hurt the business, so it is okay. That's a very good question.
All right. Does anybody else have any other questions? We still have some people here waiting. I'm curious personally on the S corporation with LLC. Is it worth it to? I mean, it's a question we get a lot, and we usually steer people towards the LLC. But at what point should you decide? Should you say I might as well get a corporation, or just do an LLC with an S corp tax bracket? How do you? Is there a simple way to think about that?
No, that is a very, very personal thing. In many instances, when I review that personal situation with most of my clients that they're going to start a small business, it is a good idea to have the LLC because I call it, it's something that you can transform easily. Just having an LLC, starting the business just to make sure it makes it, and you don't have to do all the corporate stuff with having payroll for yourself and paying for a separate tax return and having all those formalities that usually the corporation requires, like having minutes and the corporate book and everything that most people who have not been in business, they probably can just miss on those things, and that can be a legal issue as well. So having the LLC starts with simplicity, with the option of just upgrading, let's say, with just one single form to a C corporation or an S corporation. It's just a tax election for the IRS. So for tax purposes, it becomes a corporation, and I can do it anytime in the future. Important thing is to plan. So that's the reason I like the LLCs. But that does not mean that the right entity type for one other specific client necessarily has to be the LLC. It can be a corporation, but that probably will be more on the legal side, like how many people are going into business, what kind of money they're putting, and what they have on their side. So that part of protection probably is something to consider. And there are some other tax benefits that some big corporations can provide to their employees, including the owner, and that is most commonly seen in C corporations. So it's a very personal scenario to consider.
Awesome. Well, thank you so much, Guillermo. Thank you, everybody who was here with us as well. I loved this session. It was good. It was informative. I learned a lot. I got a bunch of notes, and I hope you all did as well. Thank you all, and have a great rest of your night.